Hello everybody, welcome back to a brand new episode, and today I have a very good one for you because we're covering what leverage is in trading. So leverage is something which is very important if you want to trade forex or if you want to trade other things like indexes and CFDs. So I'm going to be explaining what they are, but if you want to know what CFDs are and how different ways to invest, please do check out the playlist because I've got videos covering CFD versus invest on many apps, so please do check that out. But we're going to jump straight into this one, so please do like and subscribe if you haven't already. So basically, leverage is a form of borrowing funds to increase your position size in your trades. Now that sounds pretty straightforward because it basically is, so it's easy to understand that one. In most cases, the broker will provide the money needed for the trader to borrow, so basically the money which will be used to amplify your account will be provided by the trader or the brokerage, and this is actually for a good reason, but we'll get into that in a minute. So basically, leverage allows for large profits. If you use leverage, you can get larger profits than what you can without using leverage, so it can be good for traders who know how to use it. So profits are magnified, but then the downside with that is losses are also magnified. Let's move on to the next slide, where we'll see some real life examples. So if a trader had an account balance of 100, so this could be $100, £100, that's why I didn't leave anything on top of that, and use a leverage rate of 50 times, basically their account balance would be 50 times larger than what it is. Not necessarily in the sense that they would have 50 times more money in their account, but they will be able to take position sizes which are 50 times bigger than what they normally would be able to take. So there are benefits and downsides to this. As you can see though, I think there's a great example to understand it. So it's basically somebody providing you with something to make more money and also potentially make more losses if you don't know what you're doing with it, but it can be good if you do know what you're doing with it. The benefits of leverage are pretty simple. It allows for traders to profit from smaller price moves in less time. So if people are trying to make quick trades and scalps and day trades and whatnot, they don't have to have high moves to make the large profits with leverage, especially with higher rates. You can understand how that one's going to help you. So basically you can make your money go quite quickly in a smaller period of time than what you would be without leverage, perhaps hundreds of times quicker. It just depends what you're trading with and what leverage size you're using. Anyway, it allows for larger positions in general, and that's obviously key to note because it allows you to make more money and make losses, but also allows you to go in with more in total, which can be good as well. So it may allow traders to get into positions they could not otherwise afford. So for example, if a trader, like I said, is starting off with $100 and they're using a leverage of 10 times, then their account balance is basically 10 times greater than what it would be without leverage, and this allows them to afford bigger trades, and perhaps if they afford in smaller trades, now this one is more influential on smaller accounts, but basically if they have a small account and they wouldn't be able to buy much, they can afford to buy a lot more now with that leverage. It allows for you to scale an account quickly with the right investor, so this depends on an individual and how much you know how to use it, but if you know what you're doing, you can make money a lot quicker because obviously, like I said, small fluctuations in price can cause larger profits, and this is good for when you do know what you're doing, but if you don't, it can be downside. Well, actually, we're going to move on to the downsides now. Downsides of leverage are pretty simple. It allows for accounts to be blown with small price moves and large position sizes, as these two work in combination to basically move you in the red. So basically you can be moved into the red quite easily with leverage because basically you have a small account and a large position size, so you can't cover the loss and you will get stopped out, and this basically leads to losses in general. So it also has a heightened risk once again because, like I just said, you can get stopped out, but this is quite important to note because it is quite bad when you do get stopped out and it hurts, it's painful. So smaller price fluctuations generally have larger effects, and this was also on the upsides, like I said, but it's now on the downsides because this can be good and bad depending on which way it's working. If it's working in your favour, then great, and if it's not working in your favour, unfortunately, then that's not good. So basically, they were the basic size of leverage, but I hope you enjoyed it. Please do subscribe if you want to see more, and check out the Stock Market Explained series, as I have hundreds of videos coming up explaining a lot more on the stock market there. So please like and subscribe, and I will see you in the next one. Goodbye.